The $300 billion quarter, how 4 AI companies hijacked the entire venture capital system. In the first quarter of 2026, investors poured a record-shattering $300 billion into startups worldwide. Headlines celebrated the AI boom. Venture capitalists popped champagne. But behind the euphoria lies a story that should terrify every founder, every limited partner, and every taxpayer betting their retirement on tech stocks. What's actually happening? The greatest capital concentration in venture history. Here is a number that should keep you up at night. For companies OpenAI, Anthropic, xAI, and Waymo raised $188 billion in a single quarter. That is 65% of all global venture capital deployed in Q1 2026. Not 65% of AI funding. 65% of all startup investment on Earth. Let that sink in. 6,000 startups received funding in Q1. 4 of them absorbed nearly 2/3 of every dollar. The remaining 5,996 companies split $112 billion, which sounds generous until you realize that is roughly what global venture looked like in a normal quarter before this madness began. OpenAI alone took $122 billion, a single round larger than the entire annual venture capital output of any year before 2021. Anthropic grabbed $30 billion. Elon Musk's xAI pulled in $20 billion. Waymo secured $16 billion. These are not investments in the traditional sense. They are bets so large they distort the gravitational field of capital markets themselves. Meanwhile, deal count collapsed. Q1 2026 saw fewer than 7,000 deals globally, the lowest quarterly total since Q4 2016. That is 61% below the peak set in Q1 2022. Fewer deals, more money. Translation: capital is flooding upward into a tiny number of companies while the broad startup ecosystem starves. Early-stage funding, the lifeblood of innovation, is being squeezed hardest. Early-stage deals fell to 64% of total deals, down from 68% a year ago. The founders who would build the next generation of transformative companies cannot get meetings because every partner at every fund is chasing the same 4 logos. The evidence trail: follow the money and see who benefits. The beneficiaries of this concentration are not hard to identify. Start with the mega-round participants. SoftBank, fresh off its $40 billion bridge loan to OpenAI, is doubling down on the bet that 1 or 2 AI companies will own the future. NVIDIA, which supplies the GPUs these companies desperately need, invested alongside them, creating a circular economy where chip revenue from AI companies gets reinvested back into AI companies. Amazon, already Anthropic's largest backer, extended its position. These are not passive investors making dispassionate allocation decisions. They are strategic players with massive conflicts of interest. NVIDIA benefits when AI companies raise billions because those billions flow directly back to NVIDIA in GPU purchases. SoftBank's Vision Fund needs a marquee AI exit to justify a decade of questionable bets. Amazon needs Anthropic locked into AWS. Now look at the IPO pipeline. Only 21 venture-backed companies exited above $1 billion in Q1. The IPO market remains functionally frozen for everyone except the mega-unicorns. SpaceX, OpenAI, and Anthropic, valued at roughly $1.25 trillion, $840 billion, and $330 billion respectively, are reportedly eyeing public listings. Together they could raise over $100 billion in IPO proceeds, a sum that would exceed all US VC-backed IPOs combined since the year 2000. But here is the hidden knife: when these 3 companies go public, they will suck so much capital out of public markets that every other unicorn waiting to IPO will find the window slammed shut. Fortune reported in March 2026 that cap table gridlock has become one of the defining challenges, companies staying private too long with ownership structures so complex that going public becomes nearly impossible. Why this framing serves them: the incentive structure behind the narrative. Every press release about these mega rounds uses the same language: unprecedented investor confidence, transformative technology, generational opportunity. This framing serves a very specific purpose. It creates FOMO among limited partners, the pension funds, endowments, and sovereign wealth funds that actually supply the money VCs deploy. When a pension fund manager reads that OpenAI raised $122 billion, they do not think that sounds dangerously concentrated. They think we need exposure to AI or we will underperform. This is how capital concentration becomes self-reinforcing. The bigger the rounds get, the more institutional capital chases them, the bigger the next round gets. The AI companies themselves benefit from the narrative because it establishes an implicit government backstop. When 4 companies represent 65% of global venture investment, they become too big to fail. If OpenAI collapses, it does not just wipe out its investors, it triggers a cascade across venture capital, public markets, and the retirement accounts of millions of Americans whose pension funds are exposed through fund-of-fund structures. Meanwhile, the AI boom framing disguises a brutal reality: capital is being drained from every other sector. Biotech startups working on cancer therapeutics cannot raise Series A rounds. Clean energy companies that could address climate change are being told, come back when AI cools down. Hardware startups, agricultural technology, education platforms, all starving for capital while 4 companies feast. Cloud providers are spending over $400 billion annually on AI infrastructure while enterprise AI revenue grows only $20 to $30 billion per year. That is a gap of $370 billion between what is being spent and what is being earned. Someone is going to eat that loss. It will not be the executives who cashed out their stock options. What happens next? The 3 scenarios. Scenario 1, the soft landing. AI companies actually deliver on their promises. Enterprise adoption accelerates. Revenue catches up to investment. The 4 mega companies go public successfully. Smaller startups eventually find funding again. This is the scenario every VC pitches their LPs. The probability, based on historical patterns of capital concentration this extreme, is roughly 15%. Scenario 2, the slow bleed. AI revenue grows but never matches investment levels. The mega companies go public at reduced valuations. Early investors still profit, but late-stage investors and public market retail buyers take losses. The venture market enters a multi-year correction. Deal count continues to fall. An entire generation of startups that should have been funded between 2025 and 2028 simply never exists. We lose whatever innovations they would have created. This is the most likely outcome at perhaps 55% probability. Scenario 3, the reckoning. One of the 4 megacompanies misses revenue targets badly. Its valuation collapses. Contagion spreads to the others. The $300 billion quarter is retrospectively rebranded as the peak of the AI bubble. VCs who concentrated their portfolios face catastrophic losses. Limited partners, pension funds managing retirement savings for teachers, firefighters, and nurses, discover they have 15 to 20% exposure to a sector that just lost half its value. Public markets crash. Congress holds hearings. Everyone asks how we let 4 companies capture the entire venture ecosystem. Nobody has a good answer. What you should do about it. If you are an investor, demand transparency about your fund's AI concentration. Ask what percentage of their portfolio by dollar value is in companies that have never generated positive free cash flow. If the answer makes you uncomfortable, it should. If you are a founder in a non-AI sector, this is actually your moment. The best companies in history were built during periods when capital was scarce and competition for talent was low. While every Stanford grad rushes to join the 4 AI giants, the rest of the economy still needs solutions. If you are a citizen, understand that your retirement savings are increasingly exposed to this concentration through pension funds and index funds. The $300 billion quarter is not just a venture capital story. It is your story. And the ending has not been written yet. The venture capital system was designed to spread risk across thousands of bets. What we are witnessing is the opposite: the concentration of trillions of dollars into a handful of companies that have never turned a profit at scale. The $300 billion quarter is not a triumph of innovation. It is the most dangerous capital experiment in modern financial history. And we are all involuntary participants.